All right, everyone, thank you so much for joining. My name is Mark Herndon with the M&A Leadership Council. It's great to have you with us today for a very important webinar provided by the M&A Leadership Council called Global M&A Reset, before and after and during the COVID-19 storm. We've got some great panelists lined up today and some really interesting data and discussion. A couple of things, all participants are going to be in webinar mode today, which means your webcam and microphones are automatically muted, but we want to engage in a dialogue, both the panelists as well as with participants. So be sure to use the questions dialog box in your control panel, and we'll try to get to as many questions as possible during the broadcast. And if not, we'll follow up afterwards. You'll also be receiving a copy of this deck with the survey data and some of the comments from each of the panelists after the event. If you are listening via replay only, be sure and send us an email to info@macouncil.org, and we'll be glad to provide that for you. With that, let me introduce our distinguished panelists for today. I'm delighted to introduce Tom Kane, who serves as Managing Editor of the Americas for publication Mergermarket. Many of you know Mergermarket, and as active fans and subscribers ourselves, we really value the deal intelligence that's often sourced from 700 journalists under Mergermarket and Deal Reporter, with actionable intelligence about deals, sometimes 6 to 24 months in advance, and really helping all in the M&A profession. Tom leads a team of 50 journalists throughout the region, and he's also served sister publication Deal Reporter as editor, and in the European market as deputy editor. So Tom, thank you for your expertise and what you're doing for the M&A community. Great to have you here.
Thanks, Mark. Great to be here.
Absolutely. And let me also introduce John Bender. John serves as president of M&A Partners. John has a 30-year career as an executive, a consultant, and a business person, to include running a $1 billion product division and service division with HP. Many of you know him from his executive director role during the HP Compact transaction, where he fully led over 2,000 resources in planning and executing that integration. Since then, John and his teams have led over 50 full cycle and acquisitions with a variety of due diligence, integration, transformation, functional and program management support. And M&A Partners serves global acquirers in all phases of building M&A capability and executing across the deal thesis. So John, welcome. Good to have you here as well.
Thanks, Mark.
You know, we've been asked since the survey went out, why in the world would you do this? We're in the midst of the worst crisis that any of us have ever lived through in the M&A business. And quite frankly, our purpose was to provide insight, direction, guidance, really an informal barometer, sentiment. What are our colleagues and peers as corporate acquirers and executives thinking? What are they doing? When do we think deals may come back? How do we make the best of this very, very difficult and challenging situation? And so it only felt right to us to talk to the experts among our friends and colleagues within the M&A Leadership Council, those skilled corporate acquirers that for years have a successful track record in this. And I guess to us, the so what of this discussion today, we really want to get down into some dialogue and some insight around when might deals come back? What types of deals should we be preparing for in our organizations? And what do executives and M&A teams need to be doing right now to take maximum advantage and really deliver value in the midst of this very difficult crisis? Now, I will caution you that all data was completed on this survey on or before March 31. With things moving so rapidly on a daily and hourly basis from every perspective, corporate, personal, health policy, et cetera, we know these viewpoints are going to evolve over time, and we will continue to gauge and provide relative insights and actionable intelligence as we navigate our way through this. But bear in mind, this is rapidly evolving, and I think you'll be pleased with the data that we'll be able to provide here. Let's quickly go ahead, gentlemen, and jump right into the demographics of the survey. We were very pleased to see a high level of senior executive decision makers responding to this survey. Now, I want to pay a special thank you to 50 organizations who participated in this survey. Even though it was brief, our intention was, again, that directional guidance as opposed to fully predictive metrics or a scientific measure. But you see that these individuals are the real voice of experience. We're also delighted that a high preponderance of the respondents were true corp dev M&A strategy, hands on the wheel, those individuals driving acquisitions throughout their organizations. Also, we are pleased with the revenue size or the annual turnover of the organizations. Good solid balance in all revenue segments to include a significant percentage of $1 billion or above. And if we click down in that data just a little bit, we found that 24% were actually Fortune 500 global acquirers. So I think it's a very reflective data set from many perspectives. And I would also emphasize that we are pleased with the industry balance in this. And I want to just do a quick mic check. And for our team, John and Tom and April, how's the audio coming across so far?
Good.
Hearing you loud and clear.
Okay, fantastic. So if you're having any difficulty hearing, I think maybe the adjustment may be on your side, but please keep chatting or providing questions if we need to do any mid-course adjustments here. So thank you for that. Just to complete this thought, and then let's dive into the data, we're also pleased to see the balanced industry participation of the industries that have been very acquisitive over the last 10 years, and that in all likelihood will continue to be very acquisitive as we move forward and start our recovery. So Tom, I want to go quickly to question number one, now that we've set the stage with purpose, objectives, and a little bit on the data. Our first question in the survey really got to, hey, what about deals that are in flight but haven't closed yet? And as you'd expect, the data shows what Mergermarket has found, that a lot of organizations are trying to sort out the implications and the ramifications for live deals. But there's some encouraging news here too. Certain deals are getting through to close even in the last 3 and 4 weeks. And I think that that's, admirable. So Tom, just give us your reaction on the data first of all, and what are you seeing out there in terms of where do you have to be in a deal process, or what kinds of deals might actually be getting done in this kind of environment right now as we speak? Tom, over to you. And Tom, you may be muted.
Yeah, thanks, Mark. I think it's a really interesting question, and I'm very interested to see the data there and what your respondents are thinking and replied, because that certainly lines up with what we've been hearing at Mergermarket. So we've actually done some interesting analyses in the last couple of weeks, looking at the state of the current deal market, ongoing deals and deals that were about to be launched, and how the tornado that we find ourselves in has impacted those. And to answer your question, the ones that are getting through are ones that are later stage, predominantly. So we're hearing that anything that this earlier stage is very difficult. So John's going to talk a little bit later on about remote working and how the deal making process itself is having to change. So that hasn't stopped. People are going virtual. Things like management presentations have been taking place remotely. But while some deals are trickling through, they are in the later stages. The issue really is that there's such a gap around valuations. There's so much flux at the moment around valuations, and that's really kind of impeding anything at this earlier stage. Companies, as you're saying, are really focusing on internal and operational priorities right now, focusing on things like managing cost, making sure they've got enough capital, for some of them furloughing staff, drawing on revolvers, etc. So that's taking up a lot of time and focus. Some deals are going through, and it would they would have to be later stage. The other thing that we've heard and included in our recent analysis was deals that hold immense strategic value to the acquirer in terms of deals that haven't been launched. Those kinds of transactions are the ones that would likely to still be on the table despite what's happening.
Have we seen any impact in valuation, or what are your thoughts, Tom, with regard to how buyers and sellers right now with later stage deals may be thinking about valuation? Thoughts or comments on that?
Yeah, I think overall valuation is really if not the key factor right now. So with so much volatility out there in the market on a day-to-day basis, it's very difficult for people to get comfortable around valuations, to model. There's just so much flux out there. So what we've heard and included in our recent analysis pieces on this very matter is that sellers are going to find it hard right now to adjust their valuation expectations downward, and there really needs to be more consensus around valuation overall for deal flow to pick up to the kind of levels that we've been accustomed to. I think an interesting point, going back to the remote working situation that we mentioned, and deal process itself is carrying on. One thing that we picked up on is that the inability to do physical due diligence, for example, site visits, is an issue, because that is a factor that is important to buyers to get comfortable valuation. So there's lots of different factors around valuation, but it's certainly a key challenge right now.
It's a good tee up, and we'll dive into the operational execution question here in just a little bit. But Tom, I'd like to stay on this topic of what's happening to current deals right now. Your publication, the quarterly and annual global and regional M&A report, is an excellent report, and I want to click quickly to that and just provide a little bit more context. This literally was just published. This is Q1 data 2020, and we see exactly what I think everyone in the M&A market had anticipated. Any other thoughts or observations about this data that your organization has literally just published?
Yeah, that's our latest data from our Q1 trend report. So you can see here that US deal values are down to their lowest levels since 2013. And that picture is really global, actually. So if you look globally, deal value is down about 39% year on year. The interesting point here to note is that this was a trend that was happening anyway. Last year we saw overall deal value embark on a downward trajectory. If you think back, I mean, it seems a long way away now, but there was a lot of global uncertainty out there. Brexit in Europe, what was happening in Hong Kong, or the specter of a US election here on this side of the Atlantic. So there's a lot of uncertainty that was causing some level of buyers trading more cautiously, and that was impacting deal value. Obviously, now you throw in the impact of the pandemic, and I expect the Q2 figures to look even lower than that. I think obviously we're going to now embark on a new trajectory into a different market where there will be deal flow, there will be opportunities, as we'll discuss, but those deal value statistics are not going to look quite as rosy as in previous years.
True statement. And let me go quickly to this next slide, also from your Q1 trend report. There's been some speculation that PE buyouts could be a bright spot in the market. We're looking here at exits. So give us some context on both sides of the PE equation, both potential buyouts and, as we're looking at here, exits.
Again, an interesting one. You can see, similarly to the previous slide, that private equity exits are at their lowest levels for over 6 years. So it's an interesting graph, but as you mentioned as well, we actually saw in Q1 buyout activity was pretty stable against the same period last year at around 190 billion, I believe, globally. And I think private equity, everyone's really watching what private equity will do from here. All of us have attended many M&A panels over the last few years where we heard about record valuations, and valuations were so high, but private equity was sitting on record amounts of dry powder at the same time. I was hearing at the end of last year something like 1.7 trillion, and there was so much money chasing too few assets. And now we're in a cycle where valuations are coming down, and there will be opportunities. Private equity has access to ample amounts of capital, and we'll look to put that to work. And there will be opportunities at more attractive valuations. At the moment, though, as we were saying previously, I think it's stage one is for private equity firms to really look at their portfolio companies, protect and secure them, make sure they have enough capital, managing cost, drawing down on revolvers, making sure they have what they need to kind of weather the maelstrom, so to speak. But opportunities will emerge, and I think you're starting to see some of that as well.
Good. Tom, I want to build on that. If that data is where we are today, let's go to the next question in the M&A Leadership Council survey, which is, what do we anticipate going forward over the next few months of calendar 2020? And what would be the impact on planned deal volume or pace? And no surprise here with the temporary pause, and we fully expected the substantial decrease. In fact, if there's a surprise in this data, I think it's encouraging that amber slice of the pie wasn't bigger, where organizations are just saying a full stop. But you've spoken to PE. We also believe that there is a significant sector of corporate acquirers, for example, that are ongoing serial acquirers that'll either be looking at this opportunistically and accelerate given additional potential targets being available, or they're going to be buyers in any market, whichever is happening. So give us your thoughts on the next few months of 2020 and anticipated deal volume and pace.
Well, I think that's a really interesting point. I think here you've really got to disassociate between the overall market's value and volume and the opportunities that we will see emerge. So as I was saying before, it's going to be a very different market. It doesn't mean there's not going to be activity. It'll just take a different form. Just on the purely data and statistics side, I think an interesting comparison point to make here, and it's one that we've made recently at Mergermarket, is comparing where we are now to where we were in 2008 and 2009, the Great Recession. So actually Q1 value volume figures were quite comparable to the first quarter of 2008. And if you think back to then, that was really a pivotal quarter in that cycle. It was when we saw the bailout of Bear Stearns, for example, 6 months before the collapse of Lehman. So it's really quite a comparable period. It wasn't until 2010, to the last quarter of 2010, that we saw the overall deal value go back to pre-recession levels, and it wasn't until 2014 that we saw it get back to the peaks of 2007. So in terms of the overall picture, that's could that happen? That's one trajectory that's worth looking at. But I think, as you mentioned, there are opportunities, and we've talked about private equity. Corporate acquirers will be looking at those opportunities as well. I think right now many companies are doing similarly to private equity, are looking at protecting themselves, covering the bases in terms of making sure they have enough capital, making sure that they have enough liquidity, etc. But there are other companies that we're speaking to at Mergermarket on a daily and weekly basis. They're emerging as winners here because they are seeing a big uptick in demand and a big uptick in what they think they will, the projected revenues for this year. For example, telemedicine, remote working, groceries. So I think there's going to be opportunities for people that have the firepower to take them.
What a tremendous segue. I want to go quickly to our next question in this section. We ask a question, what impact will COVID and the economic cycle have on acquirers' M&A strategy or primary deal type objectives over the next year going forward? And many of the things, Tom, that you were just touching on came through loud and clear. Now, this was one of those questions in the survey where the respondents can answer as many questions as are appropriate and relevant to them. And quite frankly, you just mentioned distress and opportunistic buys, for example, and we fully expected that. You see that loud and clear in the data here, Tom. 49% said, yes, we're buyers, such as PE in that distress situation. But one of my surprises here was the large percentage of organizations that are taking the approach, look, in any market, we're going to be steady at the helm. We're going to be continuing to execute against our revenue growth strategy. We have targets and acquisition vectors in mind, and I take that as encouragement for the corporate acquirer community. But there's a lot of interesting insights in this slide, and what I'd like you to do is just comment on two of the things that you believe corporate acquirers should be really thinking about as they look at deal strategy in the next year.
Yeah, well, what I'll do, I'll comment on a couple of the findings there and what we anticipate. I think the distressed finding there is quite interesting. It's certainly a theme we're really focusing on at Mergermarket. So one of the themes that we're looking at in our coverage is companies that are fundamentally strong, great companies, but going through temporary pain because of what's happening with the pandemic. So those kind of companies, in order to survive and thrive in the future, will really benefit from having the strength and support of a corporate acquirer or a sponsor. So those kind of opportunities will emerge. I think it's quite interesting this week. You saw Airbnb, for example, drawing a $1 billion financing, obviously not from corporates, it's from private equity, but it's a good example of a company that, before the start of this year was probably the most high profile public listing candidate, and it's really now poster child for what's happening in the travel and leisure space. So I think there's going to be opportunities out there for companies that are experiencing this temporary pain. Conversely, there will be opportunities, for companies that are experiencing tremendous distress as well. I think both corporate acquirers and sponsors will be looking to position themselves strategically to take those once markets return to something more calm.
Wonderful. And John, I want to bring you into this conversation as well. You certainly talk a lot in your work about deal type DNA or primary deal objectives. Just briefly set the table on what that is. And there's a surprise, I think, for me personally in this data. Tom, your comment was very instructive a moment ago about can we rely on what happened during the 08-09 financial crisis? And we clearly saw a lot more divestitures of non-core assets, or if you're on the buy side, corporate acquirers picking up opportunistic carve-out acquisitions. So, John, that's a very different deal type. Talk to us about both what deal type DNA means and what some of the challenges are if you're on either side of the table with a divestiture.
Sure, thanks, Mark. So as we look at all these different primary deal objectives, we do so through the lens of deal type DNA. And I wanted to quickly level set on distressed M&A as well as divestitures, since many individuals are not as experienced with those two deal types. But depending on the deal type, of course, there's tremendous impact to the way you want and or should be doing diligence and integration planning. Distressed M&A is very interesting, and it really depends at the end of the day on how distressed the assets really are, but it's very distinctive in terms of objectives. It's typically very fast-paced. It's driven by often the finance organization supported by corp dev and legal groups. And as a seller, often you're looking for a deal that's really ready to execute, that you can pull the trigger on with little closing risk. And that can often be very preferred over a deal that might come in at a very higher price or a higher offering price that comes with conditions, such as financing clauses or other diligence conditions that can be challenging to close in a challenged macroeconomic situation that we're in now. As a buyer, the business needs to quickly understand the opportunity in distressed, understand the assets, and assume operating in control without disturbing the secret sauce that makes the assets valuable in the first place. So from a diligence perspective, the target company's short and medium-term liquidity requirements need to be understood and defined. These requirements, by the way, are often higher than anticipated and often underestimated by buyers. And management teams need to be thoughtfully evaluated and reoriented as soon as possible after close, and sometimes adjustments are needed. On the integration side, you need to move fast, and decisions need to be moved quickly, pragmatically. A sharp focus needs to remain on the relevant financial levers. And you want to make sure the changes that you're making are closely linked to the daily business activities as opposed to launching separate programs. So it's a very different type of situation, moves very quickly. Divestitures, on the other hand, are very different. If your company finds that you are looking at pulling the ejection handle on some non-core assets, preparation is the name of the game. What you're looking for is, preparing and marketing your assets. So it's really that shining present at the birthday party that everyone wants to open first. And so to do that, best practice is really around prepping for sale. Defining the business at a sufficiently detailed level so you know exactly what's in the deal and what's not. Performing the employee census that's so critical, along with the management team that will come across with the deal. Understanding the customer base, the vendor base, your contractual obligations, and thinking about how you're going to unwind service and product offerings, and as well as back office operations. When companies optimize, when they acquire other assets, they rarely do so with an eye toward divestiture. So unwinding all of this takes a lot of prep. So after all of that initial analysis is done on current state, think about your buyers. Often you can identify who the attractive buyers may be. Think about their positions. and even begin thinking about a separation plan and a draft of a TSA. Even when you're going to market, it's not too early to be thinking about this. You understand what you're selling. You can anticipate what might be required with a transition services agreement. And those packages, if well done, drive higher value. So, Mark, if you could just briefly transition to the next slide.
Absolutely.
We summarize all this in terms of deal type DNA, and we've talked about a couple of distinctives here. Tom also mentioned that a number of strategic deals are going to continue to occur, and we couldn't agree more. They're going to be very strategic deals for scale, for scope and adjacencies and the like, and ultimately knowing what you're after drives the way you do diligence and integration. As a final example, if we're looking at a deal for scale, where perhaps you're taking out a competitor, you really need to be thinking about cost and revenue synergies as quickly as possible. So this is a really nice mental model as you're going through the process. And I think as companies are contemplating distressed and divestitures, preparation is important. There's a lot less experience in the marketplace on those types of deals.
Yes, absolutely. John, thank you for that background and relevant and spot on counsel on the point about assessing deal type DNA and defining integration strategy and execution appropriate to that. I recall one very skilled corporate acquirer in many of the M&A Leadership Council events over the last few years who characterized divestitures as not being acquisition spelled backwards. And you alluded to that. It's got a very, very different value curve that is heavily front-end weighted, and acquirers to really maximize value in the sale have to have that separation plan, that operating model detail, the resourcing, and the ability to really get at those stranded costs after exit of TSA. So excellent points on deal type DNA. In interest of time, gentlemen, let me move forward to a different type of question in the survey. The next two questions are really about how do you operationally execute M&A, not necessarily about the incidence of which deals can close or what we might see going forward in 2020, but a lot of organizations are struggling as the impact of shelter in place and work from home and social distancing. We have had many calls over the last few weeks that are saying we're trying to get deals done, but we're struggling more on due diligence. We're struggling more on integration. And so this question looked at common deal phases just in broad categories: strategy and targeting, due diligence and transaction, and integration, and asked a series of questions to what impact is shelter in place and work from home really impacting your ability to execute. Now, I just introduced this data by saying no real surprise perhaps on the strategy and targeting. We have the ability to run corp dev internally. We're tracking on target companies. We have data and models built up. We're watching announcements, and other than perhaps the in-person executive meetings to execute on or agree to execute on an LOI and start a deal process, for the most part, we can continue. But due diligence concerns me here a little bit. And in spite of the fact that due diligence has been heavily virtualized for the last 10 years or so through virtual data rooms and the like, John, a lot of organizations are saying, hey, it's a lot harder. What are some things that your organization is seeing out there that corporate acquirers can be working at to get back in the game from a due diligence standpoint?
Great question, Mark. Well, I think before delving into the specifics and the insights that the data reveals, I think we need to acknowledge that, for companies, job one is really protecting the core business right now. Senior executives and leaders are facing an unprecedented situation, and they're compelled really to think about making sure that the lights stay on. So they're really converting operations to a work from home or critical skills, critical companies kind of posture. And they're looking at customer demand. They're looking at supply chains. They're looking at whether or not they can sustain product and service line development and R&D. They're thinking about customer support in many different ways, and if those organizations are still well positioned to help post-sale. And our employees able to work from home, WFH, with appropriate security and efficiency. And only after these critical questions are being answered are they thinking about scenario planning. What do we expect to happen 6 months out, 12 months out, 18 months out? How quick will the recovery be? Things that Tom's organization is continually assessing. And when those conversations come to the table, it's then appropriate to start thinking about M&A and the role it will continue to play. From a diligence perspective, just take a look at how many respondents are saying that they're moving forward. 29% noticeable impact but manageable, and 20% little to no meaningful impact. So there's quite a lot of activity there, and we're seeing the line of demarcation that Tom mentioned, which is pre-LOI. It really depends on how far deal negotiations had proceeded to date and how good the critical senior management relationships are. Post-LOI, though, there's a lot of reevaluation going on. And depending on industry and focus, the folks are taking a second or even third look at demand, supply chains, manufacturing. They're looking at cybersecurity and adequacy of the IT shop. But they're proceeding, and diligence is taking longer. Some things that companies need to think about, given that travel restrictions are in place, is hiring specialized experts, local in-market by your target co, so that they can travel to sites and take a look, leverage technology, use FaceTime, and so on to get the data you need. And technology is definitely playing a role. Diligence is getting much more intentional. For example, facilities and IT infrastructure teams typically send out a small number of very experienced individuals who inspect the target co's sites, and they assess things including power and electrical requirements, physical security, connectivity, cooling, and an experienced individual will go out and do that almost without thinking about it, without enunciating the details. And on site, they'll develop on-the-fly insights, connect the dots, and identify opportunities, concerns, and issues. And with target co-cooperation, a very comprehensive picture can be painted. In a virtual M&A context, this is not nearly as easy. The IT infrastructure team, environmental teams, they need to think in advance what data is needed so they can understand risks to the deal, understand cost to integrate, while still being respectful to the seller, and they need to be asking for photos, videos, drone footage for sites, WebEx and FaceTime mechanisms so that they can still be respectful, but at the end of the day, answer the questions that are required. I think, what we're advising clients, Mark, is that expect a stretch in your DD timing. It's probably not feasible to do a 30-day sprint, but 75 days surely could be more appropriate. If you're in the functions, think about being more purposeful about enunciating what you really need to quantify cost to integrate and risk. And finally, if you're in corp dev or you're in an executive position, let's just acknowledge that you're not going to have all the data you might want. And so at the end of the day, a more strategic decision might be required on whether or not to proceed.
John, that's very helpful and great creative insights as you're seeing this unfold in real time over the last few weeks. So thank you for that. I'm also struck on this chart, John, by the kind of split opinion, if you will, on integration. And clearly, as you mentioned, and Tom alluded to this as well, a lot of the core M&A team have been drawn out, rightly so, on protecting the core business, on responding to business continuity needs, getting folks set up, working from home and the like. But one thing jumps off this page to me from a difficulty standpoint of just the sheer operational execution challenge of integration. Let's just take, John, for example, day one. How do you do onboarding? How do you do communications and change management? How do you do cultural alignment in a full virtual mode? Just speak to what you're seeing and some creative adaptations of the typical approach to those critical integration milestones.
Yeah, it's a wonderful question, and there is a bit of good news here. What worked before COVID-19 works now with the addition of a virtual overlay. But that being said, it's more challenging, and you need more experienced resources that can more thoughtfully and planfully articulate day one, architect the right approach, and make sure all the pieces come together. As we think about day one, we think about constituents. Customers and employees being two of the most critical, to make sure we're meeting their expectations, and I'll just use those two in the interest of time. There's planning that required, and I can't think of a single deal where this isn't uber critical. For employees, day one is about setting the right tone and trajectory for value capture. It begins the journey to get the workforce excited about the deal, ultimately, winning hearts and minds, as well as addressing the WIFM, the what's in this for me. So typically day one commences a lot of white glove, face-to-face, in-person support. HR's benefits presentations. They're working the workforces through the selection process. They're converting 401s, tremendous number of Q&A, and it all starts with stabilizing the workforce so they understand the situation from a remuneration and benefits perspective. Typically, the buyer's integration leader, business unit sponsors, and other executives are visiting, providing ready opportunities to clarify strategy, ensure intent behind messaging is understood, not mistranslated, and the like. And day one is also celebratory. So in the virtual M&A context, all that needs to be virtualized. CEOs can't travel, and so on. And so what we're recommending is that teams prior to day one take a complete look across the hire to retire and customer to cash spectrums for both employees and customers. They think about how these events can be virtualized, virtual town halls, regular small focused meetings for suitable Q&A, for cultures in which mementos and corporate swag is important and cognizant of GDPR. At day one, do the mailings to home, right? And including variants where employees can opt out if they really don't want that swag mailed to them. Customer visits via WebEx, additional portal support, additional networking time in all means to build trust and rapport. All these things can be done along with Ask the Expert and other mechanisms that really can help replicate that white glove service in a virtual environment. All that, though, takes a little bit more time. It takes a senior individual that's done it before that can say, how do we translate that using technology, tools, collaboration to pull it off virtually?
John, a wealth of insight and experience there, and I know you and your teams have been working globally in a heavily remote and virtual mode for a long time, and I think this is extremely helpful as organizations turn this corner now on current deals. Our final question in the survey, if I can quickly tee this up, is not just about responding in a virtual mode, but what impact on integration strategy, pace, or the key priority initiatives, sometimes called value drivers or major milestones, and the overall time to complete overall integration. What are we seeing out there? And I want to thank the respondents on this question in particular for a lot of really good, insightful, rich data. And we've had conversations, John, you and I, and many others that participate in the M&A Leadership Council events, where basically the conversation goes, hey, in spite of the crisis, in spite of the downturn right now and all of the unknowns going forward, my live integration is happening right now as we speak, and I don't have a really good way to do complex integration planning, or I don't really understand how to do cross-functional dependencies and really execute these core milestones. So can you click down into the how-to and project that now to what about the key things in integration that really make a difference? Key milestone cutovers, key value driver initiatives. What are you seeing organizations do to get successful at that very complex integration planning and execution?
Yeah, thanks, Mark. I mean, what we're talking about here is value-driven integration, and often deals are time-based. The NPV models require specific execution against revenue synergies, cost synergies, and other value drivers so that the deals are accretive at the end of the day. And so it's incumbent upon integrators to make sure that you have that line of sight in your integration plans and you're carrying it through discovery, planning, and execution back to that business case. And in a virtual M&A environment, value erosion can occur and perhaps even more easily at each point in the life cycle than in a standard deal. So, let's take a couple of examples about what you might want to do to ensure the right focus on the right areas of the deal. Often, complex systems integration, ERP systems, CRM, the backbone of many functional and horizontal processes are complex to do in any situation. And in a virtual context, what we're suggesting to clients is that they take one of several key alternatives, depending on deal type, pace needed, business case, and other factors. One approach is to create a landing zone, if you will, for the target co's systems environment. This has been done in a non-COVID-19 perspective at times, particularly when the buyer is acquiring someone that operates very different from an operating model perspective. You could think fintech or insurtech purchases by more traditional insurance or finance organizations. The approach here essentially firewalls the systems in a standalone fishbowl type of environment, maintaining much of the current tool set with bridging systems tied across to enable FP&A, accounting, HR, and other IT activities, but allows that business velocity and model to be maintained until long-term you can do the appropriate cutovers. Another tactic is extending the runway of your interim bridging systems, reflecting that it's going to take additional time in the virtual context to get to future state architectures, infrastructure, and apps and get all those in place. But in most cases, though, you're going to have to move forward with best possible course and speed. And to coordinate that, this is where the IMO has just simply got to operate at a higher level. Outcome-based agendas for meetings and workshops need to occur. More time needs to be put into meeting design. And candidly, in the thinly resourced models that we have, where most people are doing multiple deals, or if you're in a function, they're doing multiple strategic programs, including M&A, as well as their day job, teams don't have the time to do this. So meeting design, facilitation, all that's very different in a virtual context. It's harder to pivot a dialogue in the moment. With video conference-based facilitation, it's more challenging for facilitators to use chat and to be able to break into a video breakout session where needed if a group is off course. So the recommendation is bite these large, complex efforts off into bite-sized chunks. Just like a face-to-face meeting spawns a lot of follow-up actions and dialogue, acknowledge that will occur in a virtual context as well. Plan for it and drive more touch points. A helpful context is to think about an agile methodology where these large programs are done in 2 and 3 week sprint sections so that people can understand, make progress, and then come together and tie off across the function. So those are some of the things, Mark, that our clients and we're thinking about in this new environment.
Excellent insights, John. And again, the old adage, M&A is an experience-driven skill set comes to mind as you're thinking about how best to adapt in the current environment with all of these strategies. So thank you for that. I want us to go to the next section if we can now and look at some questions. Just as a segue, John, as we take a quick look at the audience questions that have come in, what you've just described on responding in a virtual environment and how to continue to execute your deal strategies, it really talks very well about the importance of global capabilities in M&A. And those organizations that are continuing to buy in any kind of environment have really done this. So talk to us a little bit about what are some capability components in highly skilled acquirers that you see as consistent success themes and principles.
Yeah, we haven't said a great deal about the M&A operating model and capabilities so far, and I'm glad that the question came up because it's an extremely important foundational factor in virtual M&A. And a few highlights here bear mentioning. Now is the time, particularly given that post-COVID, we're going to see an uptick in activity, whether it's distressed M&A, divestitures, or core strategic deals, to make sure you really have your operating system in place. A couple of highlights here. We would encourage everyone to take a look at their enterprise and functional capabilities and make sure that there aren't any gaps in their lifecycle frameworks, their governance model, M&A roles and responsibilities, and a complete articulation of current state at the functional level. Now's the time to dust off those lessons learned from past deals, take a look at what the challenges were, and really tune and adapt your overall capability to be ready. Also, take a look at your playbook and make sure that it's really ready to go. And to the extent that it makes sense, if you do see a pipeline post-COVID, get that purpose-built software launched, stood up, and people enabled to leverage it so that we're taking more mundane tasks out of diligence, discovery, integration, planning, and execution. In a virtual environment, tools and capabilities are much more important. You don't have the collaboration time to do Q&A. You don't have the trusted relationships built up over lunches, happy hours, and dinners. And when you think about just the seller-buyer dynamics, there isn't a common culture, there isn't the trust, there isn't the relationship build. So making sure that the workflows are clear, the tool sets are clear, how to use, when to use, and all the policies need to be put in place. And without a good set of core capabilities, you're just increasing the difficulty on the dive, so to speak.
Great. John, thank you for that. And that gave us a little bit of a chance to look at questions. And so we want to switch now to the questions portion of our discussion. Those of you that are participating with us, please use your questions control box, and we'll take a number of these. One that I'll tee up initially, an excellent question that has just come in. We've all read so much about in the last 2 weeks, the Paycheck Protection Guarantee Program passed under the CARES Act and now administered by the SBA. That's rolling out. Many target organizations are either participating in that, or perhaps a large corporate may be buying a target company that is anticipating participating in that. So the question is, if a target company that fits the criteria receives a Paycheck Protection a guarantee loan that is subsequently post-close turned into a grant, what impact on valuation would that have? And I find that a fascinating question. And we just had this conversation a couple of days ago with a transaction attorney and a transaction CPA advisor that are actively involved in the M&A Leadership Council in a live family deal that we were able to support. What the outcome of that was, I think, was very nominal. I mean, quite frankly, at first, everyone was scratching their heads and going back to the drawing board. And you'll recall the specifications. If X% of that is spent on payroll protection as opposed to other OpEx uses, most, if not all of that, would be ultimately granted. And the solution in this case, perhaps it would fit for you, is consider that part of the post-closing adjustments to the transaction, similar to a working capital threshold. If we're over or under that working capital threshold, we know the automatic ratchet adjustment on the purchase price, or other similar kinds of post-close adjustments. So hopefully that answers your question, but great heads up play, and thank you for that. Tom, any other thoughts on that before we go on to a next question?
Well, I think you've answered the valuation from the valuation perspective there. I would just say that we have been speaking to a number of companies over the last few days that are looking to access the PPP. So I think that's going to be a question that will be in the forefront of a lot of corporate acquirers' minds.
Right.
We've spoken to companies in diverse industries, from manufacturing, healthcare, services, and others that are looking to access the PPP and other government funding. So I think it's going to be a really interesting issue and challenge to watch.
Excellent. Thank you for that. Quickly going to go to a next question. Another excellent question. What diligence or valuation factors are being looked at more closely than before? And I'll tap each of you for just some top of mind reactions to this. I would start with quality of earnings. In this environment, isn't quality of earnings all the more important than it's ever been before? Now, it should be, and typically is, a very fundamental part of a quality due diligence effort, but we've got to get behind that number and really understand the business, the operating model, the assets, the margins, to really get a sense of what will be the recovery cycle on the asset or the business, and what will be the potential net impact of that. So that's one thing that I put high on the list to do additional real analysis on. Other thoughts or comments, John or Tom, on that question?
Yeah, Mark, I think the entire customer to cash cycle needs to be interrogated at a much deeper level, and absolutely quality of earnings, understanding what we're going to be seeing on demand side. But I think supply side is just as important. The current thinking is you need to understand your supply base, but in the current COVID environment, it goes even further than that from assurance of supply. So I would be looking to double click on that, as well as looking at opportunities to nearshore and to take other strategic actions to just protect the entire customer cash cycle.
Excellent. Yeah. Tom, any thoughts on that?
Nothing really further to add. I agree with what John's saying. I think quality of earnings will be a key focus. I think what we're focused on is, the flux that I was referring to earlier in valuations and the difficulty that both sellers and buyers are having. We'll certainly be monitoring the various criteria that help to bridge that gap as we go over the next few months.
Tom, we've got two questions here that are excellent and straight up Mergermarket's alley here. The first one was, what might be the timing when private equity companies will start using their dry powder? We spoke a little bit about that, but put that in, finer context, if you will, for us.
Well, going back to what I was saying earlier, I think the focus over the last 3 or 4 weeks and the current focus has been on securing and protecting portfolio companies. But we're starting to see some activity. I mentioned the Airbnb deal earlier, so I think opportunity is starting to emerge. We're hearing of various different deal types that could be on the horizon. So, for example, for companies that have listed recently might require funding in the form of pipes. That's something that we're expecting to see more of. So I think it's really going to depend on the transaction type, the sector, but I think you'll see certainly a pickup in activity as we emerge from the pandemic towards the end of the year. But it's certainly happening already in various pockets of the market in different forms, as I just mentioned.
Excellent. Yeah, thank you. I think that's spot on target. Let me ask the kind of flip side of that equation, maybe. The question has come in. We've always talked a lot about the importance of the strength of the buyer's balance sheet. Now, clearly from a target standpoint, that's a critical due diligence area as well. But the question here is really about corporate balance sheets and having sufficient cash on hand and credit facility availability to get off the sidelines in third or fourth quarter 2020. So, do you have a viewpoint? We've heard what you've said about PE. What about corporates? How are they going to be positioned coming out of this to potentially use cash for acquisitions and credit facilities?
Yeah. Oh, what I've been hearing is that right now for any strategic acquirers, it's a time to think ahead, to plan strategically for the opportunities that might arise. We spoke earlier about companies that, rather than batting down the hatches, are actually emerging stronger from this because they're seeing a big uptick in demand. So I think it really, again, depends on who the company is, which sector they're in. But I think right now is a time to kind of plan strategically for the opportunities that arise towards the end of this year and early next year.
Tom, excellent. Two questions here that I think we've got time to get in, and then I want to go to each of our panelists for just some brief closing comments. And for those of you joining, we will end right at the top of the hour, but fascinating discussion and questions here. I have to address this. Excellent question has come in. How do you see the current global pandemic affecting deals in the energy sector? And I have to tell you, being headquartered in Texas, one of the real hotspots of the energy sector, I believe that the industry analysts and certainly those of us in region and very actively involved in the sector are anticipating a bit of a double whammy. Now, depending on which side of the equation you're on, that could be opportunistic, but I'd say that is an area of the industry economy that will be more like the 08-09 financial crisis, and especially compounded with the Russia-Saudi battle to kind of force out some of the mid-market service firms and fracking firms especially. So I think that is going to be even more heavily impacted than some of the other sectors, just based on the organizations that we're talking to. Tom, any insights on that before we move on?
Yeah, I agree with you. I think that obviously oil and gas companies are dealing not just with the fallout from the pandemic, but the fallout from the crash in oil prices. We have recently put out some analysis pieces as well on M&A in that space, and we're finding that there's kind of a temporary pause. A lot of them are in distress, restructuring. So certainly an interesting space to watch. But I think there are a lot of sectors that are impacted by the pandemic beyond the obvious ones like energy, maybe like travel, leisure, hospitality. I think you're going to see other industries that are adjacent to those that may be healthy now, might be experiencing temporary impacts that will give rise to opportunities as well. So I think there's going to be opportunities across the board.
Fantastic. We'll probably have to close on this question. In this environment, I'm curious what a best practice for forecasting might be, given the obvious unknown of the pandemic. And excellent, very insightful question. Thank you for answering that. My quick reaction on that would be, John, I think something you mentioned earlier, which is scenario planning, becomes all the more important. The proverbial investment banking answer on that is the only thing that you know about a forecast is it's going to be wrong. But if the thinking process and the analysis process helps to pull back a bit more insight on the underlying factors and what may happen, that's probably the best part of the exercise. So many more iterations of forecasts and scenarios to test all various outcomes, both on the health side as well as on the economic recovery side. And with that, I want to thank each of our participants. Excellent questions. If we didn't have a chance to get to yours during the course of the discussion, we'd love to follow up with you. You'll each be getting a copy of the deck. But to each of our presenters, if I could quickly ask for just some summary comments and some thoughts as we wrap up our discussion of the data, how corporate acquirers are responding to a very challenging environment, and suggested next steps. Tom, how about you first?
Well, I think what I'll comment on is, what we're seeing corporate acquirers, corporates generally doing, and again, it's a couple of stages. So for those companies that are, for most companies out there seeing an impact and experiencing the tempest that's going on, shoring up their base, protecting their balance sheets and their people is step one, and then positioning themselves strategically to emerge from the crisis with the firepower to take advantage of the opportunities. At the same time, those companies that I've mentioned a couple of times that are seeing an increase in demand and will emerge as the strong winners from this crisis. So I think there's certainly going to be fascinating to watch how various corporate acquirers that fit into both those categories emerge over the next 6 to 12 months.
Thank you. Yeah, spot on. Appreciate that. John, quickly to you.
So leveraging Tom's comments, I would say three things. Number one, protect the core. First, make sure from a business continuity perspective, you've done everything to secure the financial health and operations of your organization. And then begin that scenario planning that we spoke about. There's a number of excellent models out there so that you can then drive the inorganic components of your strategy. I think number two, build M&A capability and readiness. Get your DMO and IMO in shape. Diligence and integration in a virtual environment takes a lot more than planning, a VDR, and tools. Strategically, our legal, HR, finance, and others ready for early screening and valuation in a virtual environment. Operationally, our IT, ops, sales, marketing, and other functions really ready to engage virtually as well. Have your experts decompose what they do. Think about, and they do that without even thinking about it, and have them translate that into the virtual environment using tools and technology. Nail those basics. Maintain a maniacal focus on customers and employees. And then lastly, overlay that with virtual program management capabilities. I think, from a leadership perspective, be ready to build the right team. In the virtual context, these are not side of desk jobs. They're not training programs for folks new to M&A. Build the right team, make sure they're ready to execute. If you're in program management, identify or bring in experts who can help you architect your approach from due diligence through long-term value creation, help you decompose the defining moments in any integration, decompose big room planning events, and get those teed up and run in nimble, digestible chunks. And focus on change management and comms. There's a saying out there, the soft stuff is hard stuff. Well, the soft stuff is now really, really hard stuff. So make sure you've got the right focus on all the people components of your deals. Right infrastructure and tools, of course, goes without saying. the right purpose-built software, collaboration tools, and application, but, explicitly talk about how it needs to be used and when with appropriate policies so people know what the expectations are.
Excellent. And thank you both for your comments, your expertise, your wisdom. Thank you both and your organizations for partnering with the M&A Leadership Council to serve the corporate acquirers. For my closing comments here and to keep us on time contract, I would just simply say, stay engaged as corporate acquirers. I'm pleased to announce that the Leadership Council will be going forward with a series of engagement roundtables, best practice spotlights, online learning opportunities to enable you to continue to probe and learn from your colleagues that are out there working live deals and responding to these challenging situations. So stay engaged with the M&A Leadership Council and your colleagues on a weekly basis. Also continue to keep your skills sharp. We were talking with a global acquirer just earlier this week, and with the migration to online training, now many more people in organizations are able to take advantage of online and remote learning platforms. So keep the skills sharp and build those resources so that you've got readiness, John, as you were talking about. And finally, we know from 2008, 2009 that invariably in this downturn, M&A people are going to be impacted by job dislocation. And one of the things that we believe is a very important service to offer for the M&A community is to help ensure certification, to really put your career and experience in the best possible stead for the best possible opportunities. So on that note, I want to say again, thank you to each of our panelists, thank you to each of our participants, and we look forward to doing just this, engaging with you, learning with you, and helping as you continue in your professional development efforts as a corporate M&A practitioner. Stay safe out there, everyone. Be well. All the best to you and your loved ones, and we look forward to engaging with you again soon. Have a great day. Take care now.
Thanks, Mark.